Okay, we're going to actually go over some entries for Mike's Beauty Transport 3000, again, in this accounting equation format, which again, I can't emphasize this enough, is a learning tool and is not used in practice. So if it seems clumsy and a little bit, maladroit, it is, because that's what we don't actually do accounting in this format. It's just a tool just to get acclimated to the accounting equation. So let's look at the supplement here. And this is in the packet. If you look at my source material, see that page right there, first page of the first supplement, and you'll see for the assets we've decided to designate for this company 4 as our starter kit. Think of it that way. Cash is kind of your minimum there. And then if we want to do business with anybody who's going to pay us later, we'll need to have an account receivable, so we have that there. When you look at supplies, just think of that as it's a dumping ground for like any kind of sundry items that we might acquire. Things we're going to just, we're just going to use them up, like pencils, paper clips, and the like. So, that's just a catch-all for that. And of course, this is a delivery service, so of course, minimum is to have, some sort of account designating trucks because we have delivery trucks. All right, so for the right-hand side of the accounting equation, took care of assets. We just have the one liability account, accounts payable, and because it's a corporation, we have a minimum of at least common stock and retained earnings. Now, what you'll notice is retained earnings is such a complicated concept that we have subcategories, and that's how we're going to account for things that affect retained earnings. Is not directly in retained earnings, but is in these subcategories of retained earnings, which will be defined one at a time as we go through the various transactions. So I'll flip back to the other slide here. Okay, so this is the 10 transactions that we're going to cover here. Now, of course, this is a startup business, so that means it doesn't exist. So it's going to be always your business's first step is when you're a startup is to, designate some amount of funds available for use as a startup. So in the case of a corporation, it's going to take the form of issuing shares of stock. That's how it'll always manifest. So we have 50,000 shares of stock. In this case, it's a single individual self-incorporating. That's a very common practice nowadays. So it looks, again, it's about keeping the, dare I say, facade or the appearance of separation up. That's one of the key things if you decide to make yourself a corporation, more or less. In other words, I'm going to make a business over here that's separate from me and my personal assets because, again, to go back over a concept that we touched upon earlier in an earlier video, is that we want that limited liability, right? We don't want anybody to be able to come after our personal assets. So in this case, that's what Mike Nelson's looking to do, is just shield himself from unlimited liability. So it would only be the corporate assets that somebody could take as a creditor. They couldn't come after his personal assets, as long as he follows all of the strictures and rules of the corporation, separate accounts and whatnot. All right, so in this case, the startup capital for this is going to be $1 million cash. Now, it could come in the form of cash and other assets, but in this case, it's just cash. So when you have this situation where you have an exchange of shares of stock for cash and other assets, this is referred to as an investment transaction. And again, it's going to manifest, because we're a corporation, as an issuance of stock to one or more parties, at least one party, of course, in exchange for cash or other assets. And again, what's the rule for other assets? Those are recorded at fair market value. Now, again, if this company never issues more shares of stock, which you're going to observe here, so let's look at how that transaction looks on the accounting equation format here. So of course the corporation is going to have more cash, so that's number one there. So you see an increase in cash, and the offset is we're going to do an increase in common stock. Now again, if they don't issue any more shares of stock, that's going to be the balance of the common stock account in perpetuity for this company. It's not going to be any higher or lower than that. So again, it's kind of a fairly stagnant account as we look at. I included these balance lines just as sort of a proof that, hey, guess what? We're still maintaining the equality of the accounting equation with each and every transaction. In other words, we're abiding the equal sign that we have to abide right there. All right, so that was just our first one. So now we exist. That's the way to look at it. Company now exists. So what's going to happen is number 2, they're going to buy. So here we are at number 2 in order of succession there. So now we're a delivery company, so it might be a good idea to do what? Buy some delivery trucks, right? So in this case, for $250,000, we're going to procure 10 delivery trucks. So that's going to look like so, right? So what we have here for number 2 is it's basically a swapping of one asset for another. They have $250,000 more in trucks, but guess what they had to do? They had to surrender $250,000 in cash. Now you'll notice I put the reduction of cash in brackets because it's a little bit more reader friendly than using minus signs. That's kind of a no-no with some of these handouts, and as I've seen them through the years, is you put a minus sign, sometimes they get washed out and you can't see what's going on there. So the bracket serves as a indication of a reduction instead of a minus sign. So it's a surrogate for that. All right, so again, our balance is still $1 million equals $1 million here. I will not belabor that point, by the way. I'm just pointing it out briefly. So, but we've seen that the composition of assets has changed, not total. So we went from $1 million in cash to now $250 in trucks, $750 in cash. So just same total assets, just how they manifest is a little different. All right, so we'll go and look at transaction number 3. Okay, what you're going to see in this one, I'll point it out immediately, is that there's this phrase on account or on credit. I stick with the on account form still and have for many years because there's a little silent portion going on there, like like it's implied based upon the context of what you're doing. Okay, so in this case, the business is purchasing, in this case, an assortment of supplies from Tom Stationery on account or on credit. Again, these are identical concepts for $3,500. So when you see this form, generically, of a purchase of something, any asset on account, the silent portion here, the portion you're not hearing, is that means that they're buying it on accounts payable. In other words, what you'll observe here is that supplies go up in the case of number 3. Try to draw my, that circle got away from me, whatever. So $3,500 in supplies, yes, but of course they're going to pay for it later, so it shows up as an increase in accounts payable. Now, what if instead of it just said purchase supplies $3,500? How would that transaction look? I'll get rid of my overlarge circle there and start that over. All right, so in other words, in this case, you wouldn't have anything here. You would have, I'll try to draw the bracket, you'd have a minus $3,500 under the cash. Of course, it would be a lot neater in a typed form than me drawing it on the screen. In other words, it would be supplies go up $3,500, cash goes down $3,500, just like we observed in the case of the purchase of the trucks. That's what it would look like. But I throw on in there on account, and then suddenly, ooh, that changes the form here, doesn't it? Now it looks like that. So again, that's why phraseology is all important here, because it can literally change, drastically change how you interpret the information at hand. All right, so that's number 3. Again, so everything still balances here. I'll try to redraw the circle a little bit neater there. So we've gone through the first 3 transactions. Now we'll pick up with transaction number 4. All right, for this one here, we're going to see on account taking on a different meaning, again, as promised. In this case, we're going to have MST3K is going to deliver 2,000 refrigerators to Crow's Appliance Emporium on account for $50,000. Okay, so what just happened there? Again, we're going to label this a form of revenue. And again, what's the standard for revenue? Revenue is earned when what? When providing services or selling goods to a customer. So in this case, we provided a service, we delivered something for somebody, and then to go back to the on-account portion of this, so in other words, we provided a service for a customer on account, so the implied missing piece here means it's on accounts receivable. In other words, the customer is going to pay us later. So this transaction 4 will look like so. So again, we want to recognize the revenue, and in this case, revenue will be indicated with the account name fees earned. Now you'll notice that's represented as an increase in retained earnings. Everything else you'll note, and yes, I do use minus signs there because brackets don't really fit the form I have, all of those will be subtractions. So really, revenues are the only thing that is increasing your retained earnings. Everything else is going to be a ding against it. It's going to reduce it. So we have to recognize the fees earned, the revenue there. And then the offset is to say, well, exactly how is this impacting our business in terms of the asset function? In this case, it's impacting us like so. In other words, the customer owes us $50,000 that they will pay later. It was $50,000 on account. And that's consistent with the language here. All right, let's look at 5. Now 5 you'll see right there. Oop, trying to do arrows, not exactly turning into arrows, more like just smudges. Yeah, there we go. All right. Practice makes perfect, as they say, or not. Okay, now we're going to deliver 10 pallets of electronics to Gypsy's Radio Shack for $15,000. This is also a revenue because, again, we're providing a service for a customer. Now, since I don't say how they pay, you'll notice what's the default? Well, we have to assume, again, we're still recognizing revenue, of course, in transaction 5. Here we are. But this case, it's an increase in cash. One thing I want to point out is with respect to the impact on retained earnings, did it matter? Did it matter whether or not we received the cash at the point of it being earned or not, as far as like, in other words, do we have a different opinion about that revenue because the 50,000 isn't going to be paid till sometime later versus the 15 that was paid now? And the answer is no. We weigh them both equally, right? We don't have a special, we don't put an asterisk next to the 50,000 like, oh, we haven't received any cash yet, because we really don't care about cash in this class in financial accounting with respect to what we're going to be measuring, which you'll see in the next video when we talk about financial statements. We're just looking to use a standard that's a little more all-encompassing in cash, which is a little bit limiting. All right, so let's look at number 6 now. Okay, transaction 6 is going to shift gears a little bit here. So there we are in 6, because now in this case we're going to have the company, in this case MST3K, is going to hire Pearl's Garage to perform routine maintenance on the trucks, $5,000, and we're going to label this an expense. And again, what's the standard there? Standard there is expenses are incurred when the corporation uses goods and services. In this case, we're using the service of repair of a garage. So how is that going to manifest in terms of impact? So it's going to look like so. So for number 6, in other words, it's kind of the necessary evil of business, way to look at expenses. In other words, if you want to generate revenues, guess what? You're going to have to probably incur expenses. It's just the way it is. No way around it. So it's going to impact retained earnings negatively. So it's a minus 5,000 impact on retained earnings. And of course, I didn't say how we paid, so we have to assume cash. There's nothing else that we can go by. All right, number 7 is going to be the third use of on account. You see it right there. In this case, we're going to pay $3,500 to Tom Stationery. Now, who is Tom Stationery to this business? This was a business that we purchased something on account from, right? So they're a creditor. So it says if you pay some company on account, it will always look like this. In other words, it's paying off the liability. So the liability goes down, and of course, how is it going to go down? Well, you're paying cash equal to the same amount, $3,500. So you'll see now the accounts payable balance is down to 0 as a consequence of that. Transaction number 8. Almost there right now. Okay, so we're on account of, makes its another appearance, its 4th and final appearance here. Now we're going to receive $50,000 on account from Kohl's Appliance Emporium. So in this context, if we're receiving money from a customer on account, it means that we're receiving it on accounts receivable. So you'll see in the case of 8, we're swapping one asset for another. In other words, we're swapping actual payment, yay, that's what we want, for the promise of payment. So we take the promise off the books, so reduce that, AR account to nothing, and then increase cash by $50,000 as a consequence. Okay, what we have left now is 9 and 10, almost there. All right, so for this one, MST3K is going to pay Mike Nelson $25,000 for personal use. Anytime you have assets being removed in the company, we're going to call that a dividend. So that's, again, falls under the category of payments and distributions of assets to the stockholders. Same impact on retained earnings as an expense, but it's treated differently because why? We're not using goods and services. So you'll notice we account for it. So 9 looks like going back to 6, I should say, because that was the repairs expense there. So it has the same basic impact. So we'll see a reduction in cash and a reduction in retained earnings. But again, you'll see when we do financial statements, we actually account for this differently. And lastly, so last but not least, number 10. All right, supplies used during the month were $2,500. And this is, again, another example of an expense. Or I could stipulate it as what? Supplies remaining were $1,000. And again, that results in the same entry, but you'll notice it's a little more realistic because we're talking about something like supplies. We're probably not going to do like an actual hands-on counting of every time we use up supplies. So more likely than not, we're probably going to let the company just do what? Estimate what the remaining supplies are, right? They just estimate that it's $1,000 and back into the $2,500 worth of expense. In other words, they will just say, oh, this is what we have on hand. So if we only have 1,000 out of 3,500 remaining, therefore we used up 2,500, so take $2,500 out of supplies, excuse me. And then also the offset should be to supplies expense for a like amount. Now again, this will fall under the category of materiality as to why we permit that, because we do not consider the difference between doing an exact accounting versus an estimate to be material. And also you could throw into there cost benefit. What would be the cost to the company to do an exact accounting of supplies, and versus what would be the benefit of that? Well, we know the benefit's immaterial, therefore we say just an estimate would be permissible. Just a quick summary here. In summary, investments and revenues increase owner's equity, while we see dividends and expenses decrease owner's equity. All right, so that concludes this portion of the video series right here. Again, in the next one will be financial statements. So look for that one as coming up next.